Welcome to the Cherry Bekaert Tax Podcast with a focus today on our tax credits and incentives advisory practice. My name is Marty Karamon. I'm the national leader of our tax credits incentives advisory practice. And every month, we're going to highlight issues affecting tax credits and incentives, the tax credits and incentive landscape specifically. Examples are going to include legislative and regulatory updates, what we're seeing in the marketplace, how to manage tax credits and incentives engagements, how technology is affecting the ability of taxpayers to claim C&I benefits, some of the drivers affecting taxpayers as they make decisions as to whether to pursue credits and incentives, how to build a C&I practice, and also careers in C&I. But today, let me focus and introduce you to my two partners in our tax credits and incentives advisory practice, where the focus of our practice is incentives specific to R&D, energy, hiring, and capital spend planning, primarily from a federal perspective, with a mix of some state and local incentives in there as well. But these are my partners, Ron Wainwright and Dan Mennel. Ron, how are you and where are you today?
I'm doing very well, Marty, and I am in Raleigh, North Carolina, which is home for me.
Excellent. And Dan, how about yourself? How are you and where are you today?
Doing great. Thanks, Marty. I'm here in Silicon Valley, home for me, the heart of R&D for tech companies.
Yes, it is. So we thought, as we began today with our focus on tax credits and incentives, one of the issues that we see many of our clients grappling with is how to choose a provider. Clearly, we're in the marketplace talking to clients, proposing certain tax credits and incentives projects to them, hopefully and theoretically in a holistic way, taking into account their overall tax positions. But we do also encounter clients who are approached by a number of boutiques today. So I thought it'd be interesting to solicit the thoughts of both Dan and Ron, and I can add some commentary myself with respect to what we're seeing in the marketplace. Over the last 10 years, I think we've seen an increase in the number of boutique firms offering to prepare primarily like R&D studies for clients. And generally, these boutiques offer a contingent fee arrangement in the area of anywhere from like 20 to 30% of the gross benefits of the credits identified. From our perspective, we do things differently. We generally spend time working with clients, scoping out benefits before we even get into a formal proposal, where we would then provide a budget, perhaps on a time and materials basis with a cap. But we do a lot of homework up front before we really get into the fee arrangement. But I wanted to first give a question to Ron. Ron, in the context of a CPA firm like Cherry Bekaert, we follow the rules under Circular 230. I was wondering if you might be able to give some thought, or our listeners some background with respect to Circular 230, why it exists, how it affects CPA firms, and how we follow it, whereas the boutiques have a different view on what they need to follow.
Excellent question, Marty. And this is a large differentiator between working with a firm such as Cherry Bekaert compared to a boutique firm. So in 1921, just from a historical perspective, Circular 230 was combined into what was referred to as a single governing circular. The Treasury Department issued Circular 230, which really speaks to the laws and the regulations governing the recognition of attorneys, CPAs, and agents who represent clients before the Treasury Department. And you will notice in that background that if a boutique firm who is a not CPA firm is not governed by Circular 230. There were some substantial amendments made in 2005, which is where I'll say most practitioners as well as clients became aware of a number of what we would refer to as, kind of well-known provisions. But what does Circular 230 contain? It contains the rules of conduct in preparing tax returns and substantial positions in those tax returns. So again, it's really for persons who are preparing tax returns and substantial positions in returns. And it gives us 6 areas of guidance. I'll only really speak to 3 today, which basically indicates that within a return, which of course an R&D credit is claimed claimed within a return, it must have a realistic possibility of the position being sustained on its merits, which from an R&D perspective, Section 41 and 174 of the statute. It also speaks to really what a CPA firm can and cannot do, which is a very large differentiator between a boutique firm and Cherry Bekaert, as well as other CPA firms, in regards to charging the client an unconscionable fee with respect to the service being provided, and that term is specifically used. So as an example, as Marty highlighted, a lot of boutique firms, the majority of boutique firms actually charge a contingency fee, a percentage of the R&D credit that is actually claimed on the return. We, on the other hand, are not allowed to do that. And we do everything on a time and materials basis. The other thing that I would highlight that candidly we see as a differentiator between ourselves and other maybe boutique firms is you cannot solicit a business using what is referred to as a false claim under Circular 230. And candidly, we do see a lot of boutique firms and just not the R&D space, but other service offerings, which will make very specific statements and claims about their practice, when in fact, under Circular 230, that would be considered as soliciting business using a false statement, if you will. So a little bit of background on Circular 230. It affects all CPA firms, and candidly, it's a quality provision by utilizing a firm such as Cherry Bekaert or another CPA firm in regards to certainly the R&D credit as a whole.
Ron, that was awesome. Thank you so much for that background. It really does set the stage for why we operate the way that we do. And I'll move the next question for discussion over to Dan right now. And I touched on a little bit of this, but like Dan, from your perspective, how do we as a CPA firm, and maybe your roles in prior CPA firms, differ in our approach from a boutique? Just sort of a free-for-all question for you, but what are your thoughts there?
Yeah, thanks, Marty. And this really piggybacks off some of the items that Ron covered. And so thanks, Ron. The way we approach this differently, we really view the credits and incentives as part of our overall tax service offering. It's not a one-off product. And we work seamlessly with other members of our firm, our compliance teams, our audit, and our advisory groups. We never offer, as Ron said, contingent fee pricing. We view the credit opportunities as belonging to our clients, not something we are giving to them. And we focus on servicing our clients end to end. We really believe our reputation is built upon serving our clients end to end holistically and putting quality above, like maximizing the credit. From the start, we want to ensure that we've addressed any issues with the ability to monetize the credit. This could be from an NOL position or any concerns on the structure. So again, thinking through what that means, that's not something that a boutique firm that doesn't understand complicated structures or potential NOL positions and the use of attributes, is not really something they can do. So that's a difference. We want to ensure that the credit, the client is aware of deadlines, state deadlines. Some of those state deadlines are fairly complicated, and you have to follow specific processes of when you file them. So we're very hands-on and help our clients through those processes and those deadlines. And if we see practices within a company that put a client at risk, we try to make proactive suggestions to them. Examples of this would be if we review a contract and there's language in there around risk or rights, and we know that they're renewing those contracts in the future, we can let the client know that, this specific language led to this conclusion. So they think about that going forward. We ensure, another example, that job descriptions exist so that clients can, again, proactively work with their HR departments and create job descriptions or create more accurate job descriptions that will put the clients less at risk under this normal exam procedure where job descriptions are pulled under an IRS exam. So those are a few examples.
Yeah, if I had to summarize what you were saying, I think we view our role as a trusted advisor specific to the credits, but really beyond that, for purposes of constantly improving. Whereas I think a lot of times boutiques are selling projects from a one-off perspective.
Yeah,
So we've
I
covered.
agree, Marty. That's a great summary. Thanks.
So we've covered the rules under which that we follow, under which we operate, and we've covered what our approach is when we're working with clients. I want to take a little bit from the client perspective, and I'll throw this first to Ron. Ron, in your career, oftentimes we will work with clients where they have worked with a boutique before, and then they end up working with us at a later time. From your perspective, what frustrations have we as a firm observed on the part of our clients when working with a boutique firm that they may tell us about, and then it drives them over to working with us?
An excellent question, Marty. I would say over my years of practice, we've seen a number of frustrations, specifically with clients that have utilized a boutique firm. So I'll start with our quality control. So quality is job one in our practice, as we know. And so we have a quality control process whereby if a boutique firm is used, and we, of course, are preparing the return to my Circular 230 comments, we have a quality control review process that we look at that claim. And probably one of the larger frustrations that we find is that we rarely are able to obtain an electronic copy or really a copy of the IRS ready deliverable in the context of the R&D credit claim that a boutique firm had used. What we've also found is they seemingly, as we call or kind of request information to do the quality control, is that they will change staff. So the boutique firms do not necessarily have a consistent staffing. What I commented is what we have found is that the boutique firms put more focus on their marketing as opposed to the quality of their project delivery. And this is important because we have seen scenarios where if the credit had been claimed by that client utilizing a boutique firm, they could have subjected themselves to a civil penalty provision in the Internal Revenue Code, which is 6676, which is actually and stands for an erroneous claim for refund or credit. And that is actually a 20% penalty of what's referred to as the excessive amount of the R&D credit claim. And so as you're being paid based on a percentage of the R&D credit, we see boutique firms taking very, very aggressive positions and actually incorrect tactical positions. So they elect incorrectly the traditional credit over the alternative simplified credit method. We've seen mistakes when calculating the credit, specifically in the context of the acquisitions and dispositions that the client or the taxpayer had occurred in their trade or business. There's very specific rules in Section 41 that talk about how we must realign in an acquisition or disposition the base years. They interestingly enough, miss a lot of opportunities as the private equity group space has really grown over the last 10 or 15 years. We see boutique firms having really almost an inability to assess the viability and or the credit among what would be referred to as portfolio companies in a private equity context. We also have found, specifically in reviewing some amended returns, that they don't understand how to file a partnership return underneath the BBA regime or the utilization of what's often referred to as the administrative adjustment regime, which came in to the statute in 2018. We have also seen where disclosures, which are required for the IRS to accept a claim, are not done correctly. That is the most recent experience we've had. And we've seen that they also, underneath the employee retention credit, another provision that came underneath the CARE Act, they do not account for the qualified research expenses correctly when they have claimed the employee retention credit underneath the employee retention credit regime that came in underneath the CARES Act in 2020. And so you're not allowed to double dip, and we've seen them incorrectly make calculations or just simply ignore the statute in regards to the haircut, if you will, in evaluating your qualified research expenses for a client that has in fact claimed the employee retention credit. So I think my conclusion or comment would be of what frustrations we find is quality. Our job is to obviously be very client advocate oriented, but we believe quality is job one. And a big differentiator beyond Circular 230 is when you're being paid as a percentage of a credit that you're claiming, you do begin to lose, in my opinion, objectivity. And actually, that is one of the areas out of the 6 that are cited in Circular 230 is where candidly, a tax or a provider cannot be in a conflict position. And so one could argue you're in a conflict position when you're providing a service and you're being paid for how large of a credit you claim. And then, as I mentioned, the real quality issue, which clients and taxpayers don't understand, is the erroneous claim for refund or credit. And we have seen that applied significantly across some of the boutique firms that we have done quality reviews on.
So Ron, it's interesting. I was on a call with a client and a boutique firm just yesterday, where I observed the boutique firm providing the advice to the client that IRS guidance was there for nothing more than to terrify taxpayers and should not be respected. And I found that we'll just say disturbing when considering that was the advice they were giving. With that in mind, and the last point here I think we'll cover today is I don't think it's only ourselves as a CPA firm that notices the differences between the way that we practice and a boutique may practice. It's also the IRS. And so for both Dan and Ron here, the IRS recently issued rules specific to claims and for refund in the R&D context. And some have made the case that these rules are a direct response to the large increase in R&D credit claims being filed by taxpayers using boutique firms. I think it makes a little bit of sense. We might have covered this on some other podcasts, but to cover what those rules are about, what they require, and then maybe we'll leave it at that for this podcast. But I think it's interesting because we've talked about, again, our observations, the way we practice, clients' observations, the rules under which we operate, and now maybe here's an IRS response in terms of the way things are, what they see in the market, we'll say in the marketplace for them, what they see out there from taxpayers and from providers. So what are your thoughts there on the new rules?
Yeah, and I'm happy to walk through that. One more comment I wanted to make on that last section about the frustrations in using a boutique firm. Ron was being kind. Probably one of the biggest observations they find out once we take over that work is that they're paying far too much. So in addition to all of the quality issues that Ron went through, most clients end up paying quite the premium for that lower quality work. So there's some irony in that. Just to quickly go through or remind the listeners about what this new IRS guidance required for amended claims. Three main points here before we make some comments or observations on those. You have to identify all the business components to which the Section 41 research credit claim relates for the year. For each business component, identify all research activities performed and name the individuals who performed each research activity, as well as the information each individual sought to discover. And then lastly, provide the total qualified employee wage expenses, total qualified supply expenses, and total qualified contract research costs for the claim year, all of which can be done on the Form 6765.
So I'll leverage off Dan's comments and speak to the General Counsel memorandum that was issued October 15th of 2021. And it's interesting to Marty's comment is that I do believe strongly that boutique firms, based on our experience, not all, but based on our experience, have a tendency to use the statute and the regulations as almost very just broad guardrails as opposed to actual law and the interpretation of the law. And so part of the background of what Dan was speaking about around the valid research credit claim for refunds, specifically in amended returns, was that the chief counsel wanted to ensure, based on their experience, that certain elements were being followed, specifically with respect to the amended return. And Dan highlighted, 3 areas around, the business components, and then clearly from the business component perspective, you're going to provide the information actually in filing the amended return around, what were the research activities performed, the individuals who perform those research activities, and then ultimately what is often referred to as, qualified employee wages expense and total qualified supply expenses. All of these elements are in a R&D study. But to my comment previously, what we found is, in fact, a lot of boutique firms do not have all those elements. They use the statute and the regulations of, just very broad guardrails, if you will. What we find and what we have found, and we did write a article on this, as well as we completed a podcast on this, is that we actually did not find anything in the Chief Counsel Memorandum that was not in the statute or the regulations. So the Chief Counsel Memorandum caused quite a stir in the boutique firm community. In fact, there was a recent article that was written by someone with a very large boutique firm, and they were actually arguing against, ironically, what the Chief Counsel Memorandum outlined as to what would be required as you filed an amended return in regards to claiming the R&D credit, not within a timely filed return with extensions. And so it was somewhat interesting to read the article because they were actually almost arguing against the tax law and the interpretation of the tax law. And remember that the R&D credit has been in the statute permanent since 1981. So it has a long life, a long history, a lot of court cases, can be often complex and misunderstood as to the actual statute and the underlying interpretation of the regulations. Well, the one thing I would highlight in regards to our practice is that we deliver an audit-ready deliverable. So in the event the taxpayer or client would ever be examined, we stand behind our work 100%. And we actually embed the audit technique guideline or provisions of the audit technique guideline in regards to our deliverable. We have not found that within any of our quality control reviews of any boutique firm, from West Coast to where Dan sits, to the East Coast in Raleigh, to where I sit, and then Marty sits up in New York and DC, and we just have not, experienced that a boutique firm stands behind their work 100% as we do. So that hopefully is some additional commentary around the Chief Counsel Memorandum, and please be aware that it is in effect post January 10th of 2022, and any amended returns that would be filed post that need to ensure that they are aligning with the Chief Counsel Memorandum.
Thank you, Ron and Dan. That was excellent. I mean, in short, any firm that does their homework on behalf of their client, that's nothing to be afraid of. I've always viewed that as an opportunity to differentiate our work from another provider who didn't take the time to have that information readily available and disclose it properly to the IRS. So with that said, I think today's been really good. Your comments have been helpful, hopefully to our listeners, definitely to me. Thank you, Dan. Thank you, Ron, for your insights. Thank you to our listeners for listening. And I guess as a final disclaimer, the material here has been presented for informational purposes only. It's not intended to provide and should not be relied on for tax, legal, or accounting advice. You should obviously consult your own tax, legal, and accounting advisors before engaging in any transaction. But thank you again for listening, and we appreciate you taking the time to talk about, or listen to us talk about, the differences between CPA firms and boutique providers. Thanks a lot.
Check out Cherry Bekaert's website, cbh.com, for the latest guidance and resources on federal and state credits and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe, and thank you for listening in. Until next time.